The holidays are over, the new year is here, and it is time to pay the piper. Typically that means the credit card bills. But when you get to that grim chore in the coming days, read the fine print carefully. It's very possible the envelope from the credit card company contains some changes. Higher interest rates, lower credit limits, all sorts of things that experts say could add up to the next wave of the credit crisis. But can regulators act in time?
Credit card is the way that families have been dealing with every emergency, every bump in the road.
Harvard professor Elizabeth Warren is a leading authority on debt and America's middle class.
Mortgage, health insurance, child care, transportation. Credit cards have been the way that families have tried to bridge that gap.
But too often that lifeline turns into a major liability. Credit card companies charging skyrocketing interest rates and high fees make it really hard for cardholders to pay off their debt and are driving American families to the brink of financial ruin. Drowning in legal fees, Andrew and Michelle began to rely heavily on credit cards. They took cash advances to help with the mortgage and used the cards for gas, food, and diapers.
You're not saying I went to Circuit City or I took big vacations. That's not what's on your credit card statements.
No.
And then Michelle got a surprise in the mail. The minimum monthly payment on one of her cards had jumped from $90 to $270.
So I call to find out this is a mistake. It has to be a mistake.
Yeah, it's almost 3 times higher than you expected.
Right. The interest rate went from 7% to 30%.
30%, 30.
30. And when I called, during that phone conversation, isn't there something you can do? We're already having trouble making the minimum payment of $90, and now it's 3 times that much, and I've never, in the 8 years I've had this credit card, ever paid late. Is there anything you can do? No, there's nothing we can do.
Did you ever figure out how long it would take to pay off that first credit card once they moved the interest rate to 30%?
It would have been well over 10 years.
10 years?
Mm-hmm.
We've talked to people who thought that if you paid the credit card bill on time, you met the minimum every single month, that you're probably okay.
You would think that if you upheld your end of the contract, that the contract was still binding. And in the case of credit cards, you would be wrong. Because the credit card companies reserve the right to themselves to change the terms of your credit card, including the interest rate, at any time, for any reason, and for no reason at all.
Paying on time is a very important element to demonstrating how, what one's credit profile is, but it's not the only thing.
Nessa Fettis, an attorney with the American Bankers Association, which represents the credit card industry, sees it this way.
Credit card rates may go up based on people's risk profile, which can change over time. Somebody who, when they first get the card, may be a very highly creditworthy person, but over time things may change and they may become more risky. And riskier borrowers pay more for credit, just as riskier drivers pay more for car insurance.
What I want to be clear on is this. A consumer who hasn't gotten worse, in other words, their credit was good enough to have the card all along, they don't feel they've done anything to make their credit profile worse. Are there cases where still the terms can be changed by the credit card companies?
Actually, very rarely.
The notion that these credit card companies are pricing for risk is a public relations sham. There's just no evidence that that's what's going on here. What they're doing is they're maximizing their profits.
One way lenders help their bottom line is with fees. Bank of America dropped Michelle's credit limit from $20,000 to $13,000, which left her vulnerable to expensive penalties.
So now we're over the limit. So now we have over the limit fees. And unless I pay off $5,000 in one chunk, I will always be over the limit. And my payment that I'm making is not going to cover even the interest. It's going to go towards fees.
So this is an added burden.
We got about 50 million American families who can't pay off their credit cards. They're rolling them from one month to the next month to the next month. And that's a bad sign. This is short-term, high-interest debt. So what we have in effect are, we got 50 million families who are walking around carrying sticks of dynamite and the fuse is lit.
Critics say it is those fees and penalties that are pushing many people in debt over the edge. Many are so overwhelmed that they feel they have only one option left. We're talking bankruptcy. There were over 1 million personal filings in 2008. That's an estimated 30% jump from the year before. And in Florida, the spike was even higher, over 65% more filings than in 2007. Lillian and Anthony say their financial situation went from bad to worse after one of their online payments arrived at the bank a day late.
They were like, well, sorry, your interest rate is now 30%, 29%, something like that.
From what?
From zero. It was a 0% interest rate card. And so then it went up to 30%. So then now they added interest on $8,000 or $10,000. I don't remember, but it was 30% interest. So
how would you be expected to pay off a card where ultimately you're only servicing the interest? That's a good question.
You're not,
I guess.
In fact, there's an argument credit card companies prefer it if you don't pay off the card. They can make more money from customers with higher interest rates on monthly payments that drag on and on.
That's exactly the sweet spot for the credit card companies. It's the person who can just barely make it, who's lost a job, who's having trouble finding another job, who diligently tries to pay, struggles to pay. Boy, that's the one you want, and that's the one you want to hit with 29% interest, because you just keep wringing those dollars out of.
For too long, credit card companies have been using unfair and deceptive practices to trick Americans into signing agreements they can't afford. They're often filled with traps and fine print that only a credit card executive could understand.
In the run-up to the holidays, the Federal Reserve came out with the first major restrictions on card companies in 3 decades. Among changes, no raising interest rates on existing card balances until a customer falls behind 30 days on the payment. And bills would have to be sent earlier to give customers a better chance to pay by the deadline.
What do you make of those new rules?
Well, the Federal Reserve is basing their decision on a lot of consumer testing. That's a good thing. We don't necessarily agree with everything they're doing, but they've gone through their process. So once it's adopted, move on.
But those regulations will not go into effect for another year and a half. And in the meantime, Congress could press for tighter restrictions on cards. Congresswoman Carolyn Maloney of New York has been leading the charge. And last September, the House passed her credit card holders' Bill of Rights by an overwhelming majority.
I support credit cards that are fair and honest. They're part of our financial system. And what my bill does, the Credit Card Bill of Rights, is level the playing field between the card holder and the issuer, so that what you say in an application is actually the truth, and that you cannot raise rates unless people don't pay their bills on time.
The reforms didn't make it to the Senate floor last year, but a new Congress is on the way, and Maloney expects action.
With all the stresses and strains that families are confronting, they don't need the added burden of unfair, deceptive practices of the credit card they own. Why can't we show them what the rules are up front and help them better manage their credit?
Elizabeth Warren thinks a law would help, but a more enduring fix, she says, would be to create an agency like the FDA or something that stays up at night looking for ways to stop bad credit products from hitting the market.
You can't buy cosmetics with ground glass in them. You can't buy apples that have been sprayed with carcinogens. You can't buy infant car seats that collapse on impact. But you can buy credit cards that will take a family that's making it month by month, and that card can explode on them and turn their financial lives upside down. We need the same basic safety standards for credit products that we have for physical products.